Welcome back to Finance and Fortune, the Grigova channel for smart money moves, financial insights, and everything you need to navigate the ever-changing world of investments. If you've been paying attention to the markets lately, you might be feeling a little nervous. Market crashes can be terrifying, right? Stocks plummeting, portfolios shrinking, and the media scream doom and gloom. But here's the kicker. What if I told you that a market crash could actually be one of the best opportunities to build wealth? That's right. Some of the world's greatest fortunes were made during turbulent times, and today I'm going to reveal the 9 smart investments to make during a market crash that could position you to come out stronger than ever. From stocks to real estate and beyond, there's a smart play for every type of investor. Whether you're a seasoned pro or just dipping your toes into investing, this video has something for you. But before we dive in, don't forget to hit that subscribe button and click the bell icon so you never miss out on more tips and strategies that can help you build your financial empire. Let's get started. 1. Invest in blue chip stocks. First on our list of smart investments during a market crash is blue chip stocks. These are shares of large, reputable companies that have been around for decades. Think of names like Apple, Microsoft, or Coca-Cola. Even in a market crash, these companies typically have the financial muscle to survive tough times, and they often recover faster than smaller, riskier stocks. Now, why should you invest in blue chip stocks during a downturn? It's simple. Discounted prices. When the entire market takes a hit, even the strongest companies see their stock prices drop. This presents an opportunity to buy into these giants at a fraction of their usual price, potentially setting yourself up for major gains when the market rebounds. Plus, many blue chip stocks pay dividends, meaning you can get paid to wait for the stock price to recover. It's like buying quality on sale and getting a bonus check while you're at it. 2. Real estate investment trusts, REITs. While real estate itself might feel risky during a crash, real estate investment trusts, REITs, offer a smart way to invest in property without the hassle of owning physical real estate. REITs own and operate income-generating properties like office buildings, shopping centers, and apartment complexes. And here's the best part, they're required to distribute 90% of their taxable income to shareholders in the form of dividends. During a market crash, REIT prices can drop along with the broader market, giving you a chance to scoop them up at lower valuations. If you're looking for stable, passive income, REITs can be a fantastic addition to your portfolio. Plus, once the market stabilizes and property values recover, REIT prices tend to bounce back as well. Look for REITs that focus on sectors poised for recovery, industrial properties, warehouses, or healthcare facilities, for example. These tend to be more resilient and can offer consistent cash flow even during downturns. 3. Gold and silver. Next up, we have precious metals like gold and silver. These commodities have historically been seen as safe havens during times of economic uncertainty. While the stock market can fluctuate wildly during a crash, the prices of gold and silver often rise as investors look for a store of value. Here's why they're such a good investment during a market downturn. Precious metals tend to maintain or increase in value when currencies weaken or when inflation is on the rise. By diversifying into gold or silver, you can help protect your portfolio from the worst of the market's volatility. Whether you buy physical gold or silver or invest in ETFs that track their prices, having a portion of your portfolio in precious metals can give you peace of mind during turbulent times. 4. Defensive stocks. Defensive stocks are another smart play when the market turns south. These are shares of companies that provide essential products and services regardless of the economic climate. Think of sectors like healthcare, utilities, and consumer staples, things people need no matter what's happening in the world. For instance, companies that produce food, hygiene products, or medical supplies tend to be much more resilient during downturns because demand for their goods stays consistent. In fact, some defensive stocks may even perform better during recessions because of their stability. Investing in defensive stocks helps balance out riskier investments, and they often pay dividends, providing a steady income stream. Companies like Johnson & Johnson or Procter & Gamble are prime examples of defensive stocks that can help safeguard your portfolio when the market is crashing. 5. Index funds and ETFs. For those who prefer a more hands-off approach, investing in index funds or ETFs, exchange-traded funds, is a great strategy during a market crash. Index funds track the performance of a specific market index, such as the S&P 500, which includes the 500 largest publicly traded companies in the US. The beauty of index funds during a crash is that they offer diversification across a broad range of companies, helping you spread risk. While individual stocks might see huge swings, index funds tend to be more stable over the long run. And when the market rebounds, so does the index, meaning your investment grows as well. Moreover, ETFs give you the same benefit of diversification, but with the added flexibility of being traded like a stock. Whether you're a long-term investor or prefer to capitalize on short-term price swings, ETFs provide a convenient way to invest in large segments of the market at once. 6. Bonds. When the stock market is volatile, bonds can be a much-needed stabilizer in your portfolio. Bonds are essentially loans you give to companies or governments, and in return, they pay you interest. While stocks can fluctuate wildly, bonds tend to be less volatile and provide more predictable returns, making them an attractive investment during a crash. Government bonds, such as U.S. Treasury bonds, are considered some of the safest investments in the world. During times of economic uncertainty, investors often flock to government bonds, driving up their prices. Corporate bonds, especially from highly rated companies, can also offer stability, though they come with slightly higher risk. By allocating part of your portfolio to bonds, you can preserve capital and ensure a steady income, even when the stock market is in freefall. As part of a balanced portfolio, bonds are an essential counterweight to riskier investments like stocks or real estate. 7. Dollar cost averaging. While this isn't an investment in itself, dollar cost averaging is one of the smartest strategies you can use during a market crash. Instead of trying to time the market, which, let's face it, is nearly impossible, you invest a fixed amount of money at regular intervals, regardless of market conditions. By doing this, you smooth out your purchase price over time. When prices are high, you buy fewer shares, and when prices are low, you buy more. This strategy reduces the impact of market volatility and ensures you're always putting money to work. In a market crash, dollar cost averaging allows you to take advantage of the lower prices without worrying about hitting the exact bottom. Over the long run, this strategy helps lower your average cost per share and positions you to benefit when the market eventually recovers. 8. High-quality bonds and preferred shares. During a market downturn, high-quality bonds and preferred shares can be excellent investments for generating stable income. High-quality bonds, particularly those issued by strong corporations or governments, offer steady interest payments. These are less risky than stocks but provide a reliable source of return, especially during times of economic uncertainty. Preferred shares, on the other hand, offer a unique mix of equity and fixed income. They pay regular dividends, often at higher rates than common stock, and come with less risk than traditional stocks. Preferred shareholders are also higher on the payout priority list, meaning they get dividends before common shareholders if a company runs into financial trouble. Both of these options provide much-needed stability in a volatile market while also offering returns that can help you weather the storm. 9. Invest in yourself, education, and skill development. Finally, one of the smartest investments you can make during a market crash isn't in the stock market, bonds, or real estate. It's in yourself. When markets are down and the economy is shaky, investing in your education and developing new skills can pay off big in the long run. Whether it's learning about a new industry, improving your investment knowledge, or picking up a high-demand skill, an investment in yourself can provide dividends for the rest of your life. The market will eventually recover, and those with the right knowledge and skills will be in the best position to capitalize on future opportunities. Take advantage of any free time you might have during a downturn to build your personal brand, network with others, or start a side hustle. When the economy rebounds, you'll be ready to hit the ground running with a more valuable skill set.